Hello and welcome to The Dig. Recently, there's been a flurry of economic and financial information coming out. And how does that impact you as a business? Do you borrow now or do you wait? What do you do with your foreign exchange currency? Is it something that you hedge? Who's better to answer that question and those questions than Katherine Li, Senior Corporate Trader from FIRMA Foreign Exchange Corporation. So let's dig in now. Hi, Katherine. Welcome to The Dig.
Hi, Ryan. Nice to be here.
It's a real pleasure having you here. This is, I think, our first time that we've been having you on The Dig. Can you tell us a little bit about what FIRMA does?
Yes, so we are a foreign exchange firm specifically catered to corporate companies. And we mainly help corporations that deal on the international markets, hedging risk on incoming, outgoing payments, and also on revenue and just protecting risk overall.
Okay, and so there's been some news that has come out this week, and that's why I'm really glad to have you on the show today. So we had some announcements from Bank of Canada. What did they say, and what does that mean to us?
So mainly, this got released on Wednesday, and this gets released about 8 times a year. And it is the interest rate decision from Bank of Canada and also the statement afterwards. Usually when the interest rates come out, there's usually a forecast about a week beforehand, and we can probably figure out if they're going to be increasing or decreasing. Surprises are not too often, but it does happen. But the main thing is that the statement afterwards is what we look at and what is the most important. Most recently, what they were talking about is the rise in commodity prices and, of course, the rise in national debt. Our current Fitch rating is at AA rather than AAA rating. So the category has dropped for our overall national debt. Which means our GDP and our debt ratio is increasing. So a lot cheaper to be borrowing money, but not enough on pace for generating that revenue to cover that. With an increased amount in that specific number, that's when we should be worried about how our economy will be shaping out to be in the next couple of years. With that said, our statement was actually rather positive because of our positive unemployment rate, which came out the week before at 8.5%. And this means that a Canadian dollar actually went up and a Canadian economy actually went up as well. Overall, it was a very positive message, even though our commodity prices are on the rise, including stuff like fruits, vegetables, oil, all very important things to keep in mind about. And of course, our government is continuing the quantitative easing program, which in plain terms, they're just printing a lot of money. And one other thing to just keep in mind about, next week, Wednesday, there's going to be the US interest rates. Again, they're also gets released every couple of months, and very, very strong indicator as to how the US and Canadian dollar moves overall.
Right. So what's the interest rate at now?
0.25%, extremely low.
So we've got that much room left to potentially. Do you actually think they could go to zero?
So back in it was back when COVID first started, our governor basically said that it's not off the table to even go into the negative interest rate. However, that was just one of those statements that he made at the press conference. Didn't have any, actual economic backings as to the plan for it to do that. But if you look at, say, the European Union, they're currently at 0.00% for a long time now, over a year. So it's not out of the question for us to go to zero.
Okay, and what would it mean if you go negative interest rates? It kind of sounds kind of funny.
It'd be really, really cheap to buy houses, that's for sure. Some of the things that you will look at is economic focus projections are going to be shifting. So it's going to be mainly on securing and helping inflation for the country. And their shift for Canada will be mainly to support our overall economy. Because with the negative interest rates, that means your bank would probably charge you to hold money with them. Whereas right now, they're giving you interest back, even though, of course, right now, savings interest is little to nothing.
Right, right. Okay. Well, that's definitely interesting, and we'll see where it goes and what happens in the future on that. So something also came out of China, some news recently. What was that all about?
So this was released around just 2 days ago. We saw a lot of volatility in the markets, mainly oil pricing. China signed a multi-billion-dollar deal with Iraq, and this is to help them with cash flow. There's a lot of salaries that are not being paid in Iraq for the major oil companies. And 2 days ago, China signed the deal to pay them in advance. And this upfront payment is not normal in the oil agreements that happen. And this has resulted in a 3 to 4% increase just in oil price alone. And as a result, in our business, Canadian dollar rallied up against every major currencies, including euros, British pound, US dollars, Australian dollars.
Okay, so it helped us go stronger. Okay.
Yeah, yeah. And actually, to add to that, there will be OPEC meetings happening. I believe it's next Wednesday as well. So Wednesday is a big day, and they'll be discussing on different, energy topics, energy markets, and how much oil is to be produced. That usually is a very big indicator as to how the U.S. and Canadian markets move.
Okay, okay. So kind of talking about Europe, there's this thing that was kind of sleepy because of the pandemic, but Brexit. What's going on there?
Yes, Brexit's always been a very, very interesting topic with us because it seems like the British people just don't know if they want to leave or not. Mainly Boris Johnson is basically hinting at a no deal Brexit again. This is I've lost track as to how many times they've gone into a no deal Brexit. But the main reason for that is because they do not have the support from France or Germany, which are two powerhouses in Europe. And there's currently no framework or trade agreements in talks at all. So for Brexit to really happen, it wouldn't really mean much. It would just mean UK is no longer in EU. So with that, there's not really any benefits to it, no actual framework for them to work on, which means not much to go from on the Brexit standpoint. So if they do reach a actual deal Brexit, it would be a shock to the system and maybe volatility will be created from there. But as of right now, it should be status quo.
Okay, so how did that have an effect on the pound, the British pound?
The pound has been extremely volatile. In the past week, just in the past 7 days, we've moved about 5%. The highs got to around 173s, and then now it's the lowest it's been since 2020, now 168, and it's continuing. At the same time, the most important thing to remember is that it's not just UK that's moving, it's more so Canadian gaining, UK losing. So it's there's a double kind of balancing act there. Both pieces of news are coming out, which great time to be buying pounds.
Well, and I think that's that's kind of the, I guess the what's this all mean? All these kind of big pieces of news as a company in Canada. What should we, what do we do with this kind of news? What is it telling us? Or what's your advice, I should say?
I would say look at your price points. That is definitely going to be a very big element for all companies to consider. If someone were to tell you that your profit margin based on FX exposure, it's going to vary from 10 to 18% within 1 year. That's a pretty big chunk. And we would say hedging and protecting that risk is most important for corporations to just mitigate what could happen again. Back in March, when stock market really faced a huge correction and COVID first started happening, we saw highs in every category. And these highs are in certain countries, whereas Canada, we saw a negative oil rate. Crude oil went into the negatives, which really impacted the Canadian dollar. And of course, certain clients were paying as high as 146s in the US dollar, whereas the norm for the last 2 years was around 130. So you saw a 16% increase within just 1 month and really made a really tough position for clients and for companies overall in Canada. So what we would like to recommend is to hedge your risk, maybe look into different options of holding certain rates and seeing your payables. Look in advance of what is coming up. And right now being the 2-year low and 2-year low for buying, so 2-year high for Canadian dollar. That's the opportunity that people should be taking, maybe locking in a certain amount of funds so that at least you're protected for the next couple of months. And of course, adjusting your own pricing based on market fluctuations.
So when you're saying the dollar's strong or high, it's relative to the US. So we have, this is the strongest our dollar's been for a long time. So locking in now protects you from any strength, I guess, of the US currency.
Exactly. And of course, it's not to say that, US is not printing a lot. I've looked at their balance sheet. You can check out their balance sheet on the FOMC meeting minutes and everything, and it looks pretty daunting. They're like at $7 trillion, and it's pretty crazy, the relief funds. But there is also US moves alongside with the stock market. Look at the pricing of the Dow and the S&P 500. Whenever the S&P 500 and Dow goes up, US dollar tends to go down. Of course, right now we're at an all-time high. 30,000 pips for the Dow is really, really high pricing. If we see of any corrections in the market, that will impact the US dollar, and which will go up. This is mainly derived from equity sell-offs, which we look at as well, just to protect overall risk.
Right. Okay. And we've seen, just on, mortgage rates, they've been kind of really low. But I think, we talked earlier that you said, well, it may go even lower. Is that even possible?
I would say mortgage rates, banks, lenders, all the lenders, they love that, the fact that, actually, I should say, they do not like that interest rates are so low. But as we know, mortgage rates are quite competitive in the markets. Depending on who you go with, the rates can vary. I would say, as a personal advice, maybe wait till January, especially with all the interest rate statements and forecasts that are coming out. They're not indicating any interest rate increases for at least probably a year, which means that we could see potential drops in mortgage rates even more than it has already.
Right. And you had mentioned the corporate lending piece of that as well. So if you're looking to maybe lock in some lending arrangements, it might be worth just holding out a little bit longer over Christmas to take advantage of that potential.
Yeah, and if you already have a mortgage, look into refinancing. We don't do this, by the way, FIRMA, but I would say just call your bank and say that, hey, how much is it to refinance? Or even just to get out of the mortgage and get a new one. Because the penalty for that, it's less than what you're going to be saving on changing that mortgage rate. Might as well save a little. Every savings count at this point.
That's correct. Yeah. Well, Katherine, it's been a real pleasure having you on the dig. It's these topics, I think, from a business coming to year end, it's something for companies to think about moving forward. What's their budgets going to look like, and We do a lot of our viewers do a lot of business in US dollars, be it in the US or around the world. So something to consider. So again, it was a real pleasure having you on the show.
Thank you for having me. It was great.